DeFi, or decentralized finance. Now, why do we need finance to be decentralized? Let's first talk about what finance is composed of. It's a really complicated field that it's hard to put succinctly, but two crucial parts of it is, number one, creating the incentive structures to move capital for productive use. So moving capital from one place where it's just sitting around to a place where it can be actually used productively. So think about loans and deposits. You might have excess cash, deposit that cash, and somebody else who has a need for capital, for instance, starting a business, can take a loan, and the bank is basically, loading out your capital, and the interest rates are the incentives for you to deposit, and the interest rate is the charge that the loan taker has to pay. So that's one crucial part of finance. The other crucial part involves giving the instrumentation to manage risk such that this productive flow of capital is even further incentivized. So people have all sorts of different assets, different currencies, and in order to encourage people to be willing to invest, there's all sorts of financial instruments created so people can kind of fine-tune their risk exposure more carefully. It's not just plain and simple, hey, I'm depositing this much, and if the market crashes, then I'm kind of screwed. The world of finance has created a complicated set of different instruments to allow people to kind of balance their risk tolerance level with the amount that they're willing to invest. So that's another big part of finance. So all around this can be summed up as creating incentive structures to move capital around productively while giving people good control of the risk exposure. So why do we need this field of finance to be decentralized? So in a lot of developing nations where they have a new currency or a regime that's highly volatile or immature financial sector, there can be issues of mismanagement, of just having not enough expertise in thinking about the technicalities and execution of financial systems, problems with the design of financial systems. And sometimes it could just be that, there are innate challenges to starting up a financial system that's quite nascent in a developing country and that has its own challenges. The currency might have high inflation, et cetera, et cetera. So a lot of citizens of these nations, they struggle with inability to convert their assets, their currency, into the assets that they want. So in some places and sometimes US dollars are scarce or really expensive. It's really hard for the citizens of these countries to kind of get a more stable way of storing their wealth. It's difficult for them to make use of the financial instruments that are available to more developed countries. As a result, this produces disincentivization of certain business activities, and also it's when capital isn't moving efficiently through the nation. It's hard on the business sector, but it's also unfair for the citizens of that country who, because of their physical location and their belonging to a certain state, they don't have access to the same wealth creation tools that other people around the world have. So in DeFi, one big reason for it is to create a decentralized global financial system where anybody with internet connection can access it, and they're able to theoretically operate on this more equal playing field where they have access to all these different instruments, financial assets, and they're able to partake in the wealth creation process that decentralized finance allows. And the same can be said for businesses taking advantage of DeFi who may not have the financial instruments available in their country. So what does the DeFi landscape look like? The goal is to create a vibrant ecosystem that fulfills the aims of traditional finance, but in a purely digital and decentralized way. So let's first look at the smaller circle. It has US dollar, bonds, real estate. So this smaller circle just represents your traditional assets, traditional financial instruments. In order to create a vibrant ecosystem in the decentralized sphere, we want to be able to not only perform financial activity with decentralized internet native assets, but also interact with the assets, the traditional assets that represent the bulk of financial activity in our world. We don't want to just leave that behind. In order to do this, we create a virtual equivalent of this asset. So for instance, you may have a virtual representation of some bond, and this is managed by potentially actually having a bond stored somewhere that backs up that virtual equivalent. So for a lot of these virtual assets, that's how it works, where there's actually some sort of value, often the same asset, that backs up that virtual asset. And with these virtual equivalents, now we can play with them and interact with them programmatically and in the same way and in the same space as these digital assets. So now there can be interactions between these two worlds. And of course, you have your usual digital internet native assets like Bitcoin, Ethereum, Stellar, that will also be part of the DeFi financial activity. Outside of these assets, we'd also want to think about other kind of financial instruments such as insurance, such as futures, such as options. And again, we want this financial ecosystem to encourage productive flows of capital and also allow people to really fine-tune their risk exposure if they're okay with certain kinds of risks, but they want to hedge against certain other kinds. Other types of financial instruments like these and other higher order financial instruments allow for the fine-tuning of risk. So in this DeFi space, we have all these different assets, financial instruments, and we want to be able to exchange. Sorry, let me write this more clearly. Exchange these assets. We want to be able to borrow. We want to be able to lend. We want to be able to earn interest. We want to be able to short, etc., etc. So here are three forms of lending systems. The first, you have your classical traditional banking system. People with excess capital store it in the bank. They earn some interest on it. And people on the other side who want to take out a loan, apply for a loan, they get their risk assessed, and they're possibly given a loan with an interest rate that they have to pay back. The second form is a peer-to-peer matchmaking system. So the second form and third form are seen both in the decentralized and centralized space. And in this peer-to-peer matchmaking system, people have assets and capital they want to earn interest on. They register their availability of their assets. And on the other side, people who have an interest in borrowing a certain asset register their interest. And the protocol does its best to match up the supply and demand. So this third form is a liquidity pool model, and a liquidity pool is just the term for stores of different assets. So you have a store for Bitcoin, stores for Ethereum, stores for USDT, and you have these pools of these assets. So when people have interest in borrowing, come and request it, it's actually available. And the protocol that manages this form of liquidity pool lending, it manages an interest rate that's based on various factors. It could be based on historical demand for that asset, historical supply for that asset, and maybe currently how much of that asset's in the pool. So based on a bunch of different factors, the protocol calculates an interest rate for depositing and lending for that asset, and those interest rates incentivize and disincentivize depositing of that asset or lending of that asset. So for instance, if some really popular asset is being borrowed a lot, the pool is running low, the interest rate for depositing might go up. So a lot of people want to deposit that asset to earn interest on it. And because the interest rate went up, it might disincentivize some borrowing. So there's less people who want to pay that higher fee to borrow it. So this is the back and forth that happens. So what are some core differences between the decentralized systems and the centralized system? So two differences I want to highlight are, number one, risk management, number two, liquidity. So at traditional banks, you have people who are assessing applications for loans. They're looking at credit scores. They're looking at the proposal for what they're going to do with the money. They might be evaluating business ideas. They might be doing background checks, things like that. So traditional banks are able to look at a lot more signals to evaluate somebody's likelihood of paying back their loan. At least as of now, there's a lot of efforts made in the decentralized space to link to various data sources, some decentralized, some centralized, and you can link to centralized sources using oracles. So more and more so, the decentralized space has more signal on assessing risk. The decentralized protocols still mostly use a form of risk management that's quite riskless. It just requires a ton of collateral. So if that collateral falls below a certain value, then it's automatically liquidated and the protocol doesn't take much loss. So the amount of collateral that's required is usually very high in comparison to the amount that you want to borrow. So if somebody has a Bitcoin that they believe will rise in value, so they don't want to sell it, but they are interested in using another asset and taking out a loan for the other asset, they could lock away their Bitcoin as collateral and draw maybe up to 40% of that Bitcoin's value to borrow other assets. And if that Bitcoin's value drops if Bitcoin drops in value, then the borrower will have to make sure that it's not reaching a point where it'll be liquidated. The other difference that I want to mention is liquidity. So because the existing centralized financial system is so mature, a lot of the assets and the instruments, the currencies that flow through the system have matured enough where there's a lot of different sources of liquidity, a lot of market maker players. Size will be really important here in the DeFi case because there is no government authority or Federal Reserve that can back up certain assets, that can provide liquidity and inject that in. In this case, there might be whales that can take certain actions, but for the most part, it depends on the scale of the network until more sophisticated systems and protocols are designed.